Hey everyone, and welcome back to the channel. Today, we're diving into a topic that's got the investment world buzzing. Unicorns. No, not the mythical creatures, but the billion-dollar startups that are changing the game. We're going to explore how you could potentially get in on the action before they go public. Specifically, looking ahead to 2026. This is the world of pre-IPO investing. So, what exactly is a unicorn? A unicorn is a privately held startup company valued at over $1 billion. Think about the early days of companies like SpaceX, Stripe, or even Byte. Getting a piece of that pie before they hit the stock market is the dream for many investors, because the potential for explosive growth is huge. But it's also a high-risk, high-reward playground that used to be exclusive to venture capitalists and the super wealthy. But times are changing. The financial landscape is becoming more democratized, and new pathways are opening up for accredited and even everyday retail investors. That's what we're going to unpack today. How can you position yourself to invest in the next big thing in 2026? First, let's get the big question out of the way. Why invest pre-IPO? The primary allure is the potential for massive returns. When a company like Facebook, now Meta, went public, its early private investors saw their stakes multiply in value. By investing before an IPO, you're betting on the company's future growth trajectory at a much earlier, and hopefully lower, valuation. You get to be part of the story from its exciting middle chapters, not just the epilogue. However, and this is crucial, it's not a golden ticket. Pre-IPO investing carries significant risks. The biggest one, illiquidity. Your money is tied up. Unlike public stocks you can sell anytime the market is open, private shares can be very difficult to sell. You might have to wait years for an exit event like an IPO or an acquisition. And here's the tough truth. Not all unicorns make it to the finish line. Some falter, some get acquired for less than their peak valuation, and some simply fail. So, this isn't for the faint of heart, and it should never be money you can't afford to lose. Alright, with the risks understood, let's talk strategy. How do you find these opportunities? By 2026, we can expect the current trends to be even more established. The first place to look will be equity crowdfunding platforms. Sites like Seedon, Vest, Republic, and WeFunder have already opened the doors for accredited and, in some cases, non-accredited investors to get into early-stage companies. While most of these are seed-stage startups, they are increasingly hosting pre-unicorn companies in what are called Regulation A+ offerings. These are like mini IPOs, allowing companies to raise up to $75 million from the general public. Keep a close eye on these platforms, as they are likely to be the most accessible entry point. Next up are secondary markets. Think of these as a stock market for private companies. Platforms like Forge Global and EquityZen allow existing shareholders, often employees or early investors, to sell their private shares to other accredited investors. This is where you can find shares in well-known, late-stage unicorns. The process is more complex than just clicking buy on a brokerage app. There are legal hurdles, and the company itself usually has to approve the sale. But for accredited investors, this is a direct way to buy into established giants before they go public. To qualify as an accredited investor in the US, you generally need an income over $200,000 or a net worth over $1 million, excluding your primary residence. Another avenue is venture capital funds, or VC. Traditionally, you needed millions to get into a VC fund. But now, we're seeing the rise of funds accessible through online platforms. These platforms pool money from many smaller accredited investors to create a fund that then invests in a portfolio of startups. This offers diversification, which is incredibly important in this high-risk space. Instead of betting everything on one company, you're spreading your risk across 10, 20, or even more. This is a much smarter way to play the game, as even the best VCs know that most of their returns will come from just a handful of big winners. So, looking ahead to 2026, what sectors should you be watching? Technology will undoubtedly continue to dominate. Artificial intelligence is a huge one. Look for companies that aren't just building models, but are applying AI to solve real-world problems in industries like healthcare, logistics, or finance. Fintech is another hot area. Companies that are making banking, payments, and investing more efficient and accessible are prime candidates. And don't forget about sustainability and climate tech. As the world pushes for a greener future, startups in renewable energy, carbon capture, and sustainable materials have enormous growth potential. Now, let's talk about the most important part: due diligence. How do you separate the real deal from the hype? First, look at the team. Are the founders experienced? Do they have a track record of success or deep expertise in their industry? A great idea is nothing without a great team to execute it. Second, analyze the product and the market. Is the company solving a real, painful problem for a large and growing market? Do they have a unique solution with a strong competitive advantage, what investors call a moat? This could be proprietary technology, a strong brand, or network effects where the product becomes more valuable as more people use it. Third, dig into the financials. This can be tricky with private companies, but you should look for signs of traction. Are revenues growing quickly? Are they acquiring customers efficiently? Who are the other investors? If top-tier venture capital firms have invested, it's a strong vote of confidence. They've done their own extensive due diligence, which can give you some level of comfort. And finally, understand the valuation. Just because a company is a unicorn doesn't mean it has a good investment at its current price. Valuations can get inflated in the private market. Try to understand how the company is valued. Is it based on revenue multiples? How does it compare to public companies in the same sector? Overpaying for even a great company can lead to poor returns. To wrap this all up, investing in pre-IPO unicorns B 2026 is set to be more accessible than ever before, but it demands a strategic and cautious approach. Start by educating yourself now. Explore the equity crowdfunding platforms and secondary markets. Understand the requirements to become an accredited investor if that's a path you want to pursue. Begin tracking promising sectors and companies. The key is to treat it like a long-term game. Don't chase quick flips. Look for fundamentally strong companies with visionary leadership that are changing the world. Diversify your investments to manage risk. And most importantly, only invest what you are truly prepared to lose. The journey of a unicorn is a marathon, not a sprint. And as an investor, you're along for the ride. This is a really exciting frontier in the world of investing. And with the right knowledge and mindset, it's a frontier you can explore. Thanks so much for watching. If you found this guide helpful, hit that like button. Subscribe for more content on building wealth. And let me know in the comments which emerging sectors you're most excited about. See you in the next video.